A multi-billion-dollar loan from some of the world's biggest banks helped Elon Musk secure Twitter. But almost 2 years later, new data shows it's those lenders who are still paying the price. Deirdre Bosa has more in today's Tech Check segment. Deirdre.
Well, Sarah, the longer that these banks hold onto those loans, the more painful it is. And according to new data from PitchBook, the Twitter takeover now represents the worst buyout for banks since the 08-09 financial crisis. Holding on to those loans, on their balance sheets, that was never part of the plan for those 7 banks, which loaned Musk a combined $13 billion for Twitter. The idea at the time was put up the capital, do a deal that deepens their relationship with one of the world's richest men, then turn around and sell the loans or bonds to investors. Many expected that Twitter's financials under Musk's control would improve, maybe even become worth more than the $44 billion total that Musk paid for it. Of course, that has not shaped up. Now X, the platform, has struggled to retain advertisers. And at the start of the year, you might remember this, it was marked down by more than 70% by Fidelity, which also participated in that 2022 acquisition. So the banks are left holding the bag, with paper losses, denting profits, increasing financial risk, and reducing liquidity available for other deals. Technically, these are hung loans. The Journal, which was first to report on the PitchBook data, put the Twitter deal in context to other buyouts and how long it took banks to offload that debt. As you can see, Twitter at the top there is by far the longest, with no end in sight. Now, ironically, guys, this has not hurt Musk's ability to raise even more money for his other ventures. VC firms Sequoia Capital and Andreessen Horowitz, they also helped finance that Twitter takeover, but unlike the banks that issued loans, they got ownership or equity. So they don't get interest payments, but it's also not burning a hole in their balance sheets, which also aren't reported quarterly. Their higher risk tolerance, longer investment horizon, that's also more forgiving. So both Sequoia and Andreessen participated in that latest $6 billion funding round for Musk's AI startup, XAI. Still, that is not to say that there are not signs of strain even for the VCs. Even that longer investment time frame is being tested. Data from Carta shows that vintage VC funds, they're returning significantly less capital to LPs than they have in years. 2 reasons for that: lack of exit, something we talk about often, and lack of realized gain. So even if they're not marking down Twitter or X on their books, they're also not realizing any gain from that investment.